I'm Maria and I'm here to talk to you about technical payroll tips. So as you're aware, today's subject matter or topics are lesser known areas of payroll and sources of confusion for payroll personnel and employers. I know that sounds fantastic, but standing up here, I really don't know what you're confused about until someone asks me a question. So what we will be looking at today: long service leave, employment termination payments and superannuation. Now this is just going through all my emails and all the questions I constantly get, and these three topics consistently arise. So we will start with long service leave. As you can see on your screen, there are three different accrual rates. However, as you can see, ACT's accrual rate is exactly the same as New South Wales, Queensland, Victoria, WA and Tasmania. It's just that they're entitled to take their long service leave earlier. 6.0667 weeks for 7 years service is exactly the same as 8.667 weeks for 10 years service. So don't let that throw you. All it's saying is our politicians are entitled to take their long service leave earlier than everyone else. That's it. If you are in that middle strip of Australia, Northern Territory and South Australia, you have slightly higher entitlements and you get 13 weeks for 10 years continuous service. Pretty simple. It is a source of confusion for many employers, but it is quite simple to determine the entitlement or the accrual. As you can see, I've given you an example up here. If you count all the yellow boxes, you'll see that there's 11 of them. There is 13 years all up. We take the 2 years that don't contribute to service, and here we have our entitlements. You can see 9.53 weeks for 6 of the 8 jurisdictions and 14.3 weeks for the other 2 jurisdictions, the ones with the higher accrual rates. Not once have we looked at how much they earn. Not once have we looked at their hours. We can easily determine the accrual just by looking at the length of what we call continuous service. Total length of service is 13 years. Take out the 2 years that don't count towards service, you are left with 11 years continuous service. That's simple. You apply the accrual rate and you get your entitlement in weeks. Doesn't matter if you're full-time, part-time or casual. Same entitlement. This question always comes up. What happens to overseas or interstate service? I don't know. What did you talk to the employee before they went overseas and interstate about? Basically, the legislation doesn't cover that. So, if it is contestant and it does go to court, the things that the courts look at: why was the employee sent overseas? Did they say, hey, I'd like to go overseas and spend 2 years in the UK? Or did the employer say, hey, we need you to go over to the UK, I'm just using UK, could be anywhere, and we need you to perform services in that jurisdiction? So the courts will look at whose decision was it to go overseas or interstate. They will also look at, was there an intent to return to Australia? Or was that secondment, whatever it may be, that transfer permanently overseas or in a different jurisdiction? Is there an intent to return? And if so, if there is a termination, is the termination occurring here in Australia or has it occurred overseas? So the likelihood is if the employer sent the employee overseas and there was an intent for them to return, you're pretty much guaranteed that that service will count towards their long service leave and length of continuous service. Whilst it's not covered in the legislation, that is the stuff that courts look at. I'm not sure if you're all familiar with this case, but it was in, I think, April last year, and good old Martin was working for Baker Hughes, and he started over in the UK almost 30 years ago, and he'd been to UK. I think he did a stint in Asia, and then in maybe 1998 came to Australia in WA. And I believe he had somewhere around the 8 years service mark. So he terminates in Australia, and the Australian entity, Baker Hughes Australia, of the global corporation says, thanks for being with us, Martin. Here's your 8 years continuous long service leave, whatever the entitlement was, 6.9, whatever weeks it was. Martin wasn't happy. Martin said, no, my service is 30 years and I'm entitled to about 26 weeks of long service leave. So he took it to the Magistrates Court in WA, and the judge said, there you go, Martin, you're spot on. Here's your 26 weeks. They said, Martin, you've been with one employer, irrespective of the fact that it's a global employer. You're deemed to have been with what we call one employer and you have continuous service. So you are entitled to 26 odd weeks of long service leave. Baker Hughes contested it back in August, I believe, and they won. So eventually, the same judge that said, yes, Martin, in his statement, turned around and said, it really should have been no, I made a mistake. So, in the meantime, between April and August, I've had 47,000 phone calls saying, oh my God, I need to accrue for all this overseas service. Not necessarily. One employer doesn't mean one global employer. When the legislation was written, it was deemed to be an Australian employer here in Australia. But those periods of absence in this particular example, depending on those questions, it may or may not count towards continuous service. It would be something you should discuss with the employee before they transfer. Same, it doesn't necessarily have to be overseas. New South Wales has a different accrual rate to Northern Territory and South Australia. So what if you transfer from New South Wales to South Australia? Does your accrual rate go up? So you've had 9 years in New South Wales and you do your 10th year in South Australia, you're automatically now entitled to 13 weeks? Something that should not covered by the legislation, you need to address it before the transfer. That's all I can tell you. All right, just looking at this, I'm just going to run through some tips for each jurisdiction. If you have nothing better to do on the weekend, you have no life, by all means take a snapshot and go through it and check if the calculations are correct. I hope no one does. Please don't. Just a couple of tips. Whilst we have same accrual rate for 6 jurisdictions out of the 8, not all of them are the same. Clearly Northern Territory and South Australia are a higher liability, but if you look at the others, they're quite different. So when you're looking at the ACT, just a point to remember, if your employee has been full-time for more than 2 years, they are paid at full-time rate. Even if they've been casual or part-time for the first 8 years and only full-time for 2 years, once they have done 2 years full-time, their entitlement will be that 9.53 weeks at their full-time rate of pay. New South Wales, only jurisdiction that works with average earnings, not average hours. If you ring the Industrial Relations Commission, they will tell you what are the average earnings, not the average hours over the last 12 months or 5 years. Northern Territory, Queensland and WA, very simple. No tips I can give you about that. It's based on your hours over the course of your employment. South Australia, look at those last 3 years, 2015, 16 and 17. We know that we have to go back for someone who's been part-time or casual and average the last 3 years. You cannot include periods of leave without pay that are greater than a week when you're going back. So you would have to use 2014, 2016 and 2017 to do your averaging. You cannot include 2015 because it was a year of leave without pay. Tasmania, include your shift penalties, the only jurisdiction that includes shift penalties. And Victoria, if the employee has had no change in their hours in a period of 12 months or more, they are the hours that are to be paid for their weekly rate of pay. So they're just a few tips for each jurisdiction. You all got that so you can read it on the weekend? Yeah? All right, great. All right, so just a couple of tips. It's quite easy, not quite easy, it's not as complex as you may think. Step 1, work out the accrual rate for the jurisdiction. It's either 8.667 weeks for 10 years service or 13 weeks for 10 years service. It's one of those two. You work out the length of continuous service. That's pretty simple too. Add up all the service and take out the pieces that don't count. That person before had 13 years service, 2 of them didn't count, so they have 11 years of continuous service. So once you've worked out the accrual rate and the length of continuous service, you've determined how much your liability is in weeks. It's determining the value of a week within each jurisdiction that's the difficult part. However, Once you've worked out the accrual and the ordinary weekly rate of pay, there's your long service leave liability. If anyone has a payroll system that can do that, please let me know, because I've not come across one, sorry. There are ones that will give you the correct accrual in weeks, but as for working out the ordinary rate of pay, I doubt there's anyone, for example, in the ACT, any system that will go back and say, oh, yeah, you've been full-time for 2 years, I'll do it at that rate. It will not do it for you. You need to know your legislation and you need to know the laws when it comes to this. So, just discuss those long service leave liabilities with finance, because sometimes it's a rude shock. Whatever's sitting in the balance sheet is absolutely nothing like what's being paid to the employee when they take their long service leave or for long service leave on termination. All right. Employment termination payments. Please don't roll your eyes. Employment termination payments. So, for those of you who have your masters in tax, and I bet you all do, yes? Because that's what you're expected to have to be able to understand what one of these is. So, if you go, basically, what the legislation states is, you can look it up, if you've got no life, what is a employment termination payment, and generally it will direct you to TR 2009/2, which is a tax ruling, and it says what's an employment termination payment. If you read it, it just says go to the Income Tax Assessment Act and have a look. And the 4 main criteria, well, 3, is that the payment has been made in consequence of termination, or you have received this payment as a result of another person's death, and you have not received the payment later than 12 months since the termination or the death. But what does in consequence of termination mean? Basically, it means if you are making this payment and the only reason you are making the payment is because a termination payment has occurred, it's an ETP. That's the simple definition. Why did you make that payment? Oh, we had to make it because they're terminating. So you think annual leave, unused long service leave, but you all have your masters. And you know, if you go to the next page in the Income Tax Assessment Act, it specifically goes through and tells you, I know I said that any payment on termination is an employment termination payment, but I've listed a few of the main ones. The other ones aren't really interesting, right? But it goes on to say unused leave payments for annual leave and long service leave, whilst they fit the definition of an employment termination payment, no, they're not an employment termination payment. The portion that's tax-free of a genuine redundancy payment, not an employment termination payment. And that's the one that most people go, genuine redundancy payment, ETP. No, if you have done a genuine redundancy payment, you will know that there is a tax-free portion. If you apply that tax-free portion and there's nothing left, you don't have an ETP. It's the bit that's left over that's the ETP. Up until then, you only have a genuine redundancy payment. Okay, the other one that I get a lot of questions about is a capital payment. So, classic question. Hi, Maria. HR have said they've settled and there's a deed of release and I have to make this payment. How do I tax it? What's the payment for? Oh, we're not allowed to see the deed. Well, I can't help you. If you don't know what the payment's for, if it's a capital payment or if it's an employment termination payment. So, the company has decided and negotiated with the employee, maybe Lisa Wilkinson, new job for you, maybe no. Right, they've said, hey, we'll give you $20,000. What's the $20,000 for? Was it because they underpaid you or because of harassment, unfair dismissal? They're ETPs. But if it's a capital payment, so let's say, I will use Lisa Wilkinson as an example. So her recent departure from Channel 9. If Channel 9 paid her a particular amount and said, like a non-compete, so you can't go to a competitor or anything like that, that's not an ETP. Yes, it's been paid because a termination has occurred, but it's a capital payment. So it's a restraint of trade. Or is there something that has prevented them from possibly deriving income from further employment? They're capital payments, so they're not employment termination payments. If it's a capital payment, you can smile because it's got absolutely nothing to do with payroll and you can give it back. All right. Unused RDOs and time off in lieu. So, I'm under the impression from the queries I received that most of you would simply process a time in lieu payment as salaries and wages on termination. So you'd pay it with their final pay. It is an employment termination payment because the only reason you're paying out a time off in lieu, not unused RDOs, the time off in lieu, is because a termination has occurred. So there is an exception to this, and if you have been kind of paying it as salaries and wages, it's not correct. However, we are aware in most, if not all of the awards, it says each time an employee does some overtime and they enter into an arrangement to take time off in lieu, it's a separate agreement in writing, and in most awards you have to take that time off within a period of 6 months. However, at any stage during that 6-month period, the employee can turn around and say, oh, I changed my mind, I lost all my money at the casino, can I have my time off in lieu, please? So they can cash it out at any stage. If they do that, it's not an employment termination payment. So if the employee is resigning or terminating and they say, can I cash out my time off in lieu, or can I receive payment for my time off in lieu because I'm not going to take it, that's not an ETP. They've requested it for it to be cashed out. Okay? So that's your little avenue to get out of it that way. All right, just on that, with unused RDOs, they are always ETPs. There's no if or but about that, they are always ETPs. Just on that taking time off in lieu, which has got nothing to do with employment termination payments, just making sure that you're all aware, you need to read your awards because, so if, example, under the Clerk's Award, I worked 3 hours overtime one day. And let's say the Clerk's Award says your first 2 hours are at time and a half and your next hour after that is at double time. If I work 3 hours overtime, I get 3 hours of time in lieu off. That's it, hour for hour. Under the Clerk's Award. Under the Hair and Beauty Award, you get the equivalent time off in lieu as per your overtime. So if I did 2 hours of time and a half, I would get 3 hours of time off in lieu. And my next hour, which was double time, gives me 2 more hours. So under the Clerk's Award, I get 3 hours off. Under the Hairdressing Award, I get 5 hours off. Make sure you distinguish. They're not the same. They're all different. So make sure you understand which time off in lieu calculation applies to your employees. All right. Tips for employment termination payments. First thing you should ask yourself, are you making this payment because a termination has occurred? If the answer is yes, resign yourself to the fact that it's ETP. Then, to check if it's not, simply go to section 82.135 because you've all got it bookmarked, yeah? Section 82.135 of the Income Tax Assessment Act and see if it fits into one of the categories that says you're not an ETP. All right, make sure you apply the correct, and I'm not going to go through this because we'll be here till Sunday, make sure you apply the correct cap to your employment termination payments. There are 2 caps, the ETP cap and a whole of income cap. Make sure you apply the correct cap. Or you can ring APA if you remember, and we'll help you. Just on employment termination payments, this is an extract straight from the ATO. Is anyone here from the ATO? All right, great. All right, so that payment... I don't know why you're laughing. That payment in lieu of notice tends to throw everybody because if you are doing a genuine redundancy payment and you have a payment in lieu of notice along with some severance and maybe something else, a lot of people get confused and say, it can't be a genuine redundancy payment because the ATO says it's an ETP. Basically, if you are paying a payment in lieu of notice to an employee who has been dismissed or they have resigned, it is an ETP. But in the case of a genuine redundancy, you need to establish whether that payment is something more than what the employee would have received had they voluntarily resigned. So I'll give you an example. Tracy, CFO, her contract says on termination of employment, either party will provide 2 months' notice. So if Tracy resigns, she needs to give 2 months' notice, and the likelihood is that she'll work her notice period. Yes? Kylie, on the other hand, is a national sales manager, and her contract says on termination of employment, the employee will receive a payment in lieu of notice of 2 months. Sounds the same, but it's not. That's saying, hey, Kylie, if you resign, you don't have to work your notice period, off you go, because I don't want you taking all our leads to the competitor or anything like that. So if Tracy resigns, she has to work her notice. She's not entitled to a payment in lieu of notice. Kylie resigns, she's always going to get that payment in lieu of notice. So if both those roles are made redundant, Tracy's payment in lieu of notice, you can call that a genuine redundancy payment, and you can add some severance in there, and you have one genuine redundancy payment, because that notice is more than she would have received had she voluntarily resigned. Kylie, on the other hand, only has a genuine redundancy payment that contains severance. Her payment in lieu of notice is an ETP, because it's not more than she would have received had she voluntarily resigned. She would have got that anyway. All right. Superannuation. Superannuation, okay. Quickly going through superannuation, we're going to look at superannuation on leave loading payments, because these are areas of confusion for many employers. Superannuation on unused RDOs and time off in lieu, superannuation obligations that the fund has, and just some legislation you might need to be aware of at the moment that's currently under review. Right, superannuation on leave loading payments. Under SGR 20092, the ruling states that basically leave loading isn't superable. But you have to demonstrate that annual leave loading payment, whether it's 17.5% or the relevant shift penalty, you have to be able to demonstrate that is being paid to the employee for the loss of opportunity to work overtime. Example, we have Peter, don't worry about Paul, we'll leave him alone right now, but Peter works 38 hours a week, never does any overtime. When he goes on annual leave, he'll get his 17.5% loading. That's superable. Why are you paying the 17.5% loading? You're not compensating. When has he ever done overtime? And how can you demonstrate that that's to compensate him for the loss of opportunity of doing overtime because he's on annual leave? He's never done overtime. So the likelihood in that case, is that the leave loading would be superable, or could be superable. Mary, on the other hand, works 20 hours a week, but due to Peter going on annual leave, Paul going on annual leave, and other people, every week, 2 or 3 hours overtime here and there. When Mary takes, pardon me, annual leave, she will get her 20 hours, and she'll also get her 17.5% leave loading. That you can show. She regularly does overtime, and now that she's on annual leave, there's no opportunity for her to perform overtime. She's not there, she's on leave. So we're going to give her 17.5% to compensate her for removing the opportunity to do overtime because she's taking annual leave in accordance with her contract or her award or her industrial instrument. So in that case, no, it wouldn't be superable, because you can show that payment is to compensate her for not doing any overtime or not having the opportunity to perform overtime whilst on annual leave. Quite different. So the key part is section 238 of SGR 20092, and it says leave loading is not payable, it's not ordinary time earnings if it is you can read it. You know what I mean. Basically, you need to be able to, sorry. I had root canal and I've taken some drugs because it's, anyway. Not illegal ones, you know. Oh, hush. All right, okay. Please feel free to ask me any questions outside. Superannuation on unused RDOs, yes. When I'm talking about, now we know basically the ATO says no super on ETPs. We all know that payment in lieu of notice is an exception to that rule. So are unused RDOs. Those RDO hours are paid out at the ordinary rate of pay, generally, yes, and they've accrued as per the employee's ordinary hours of work. So it's something like, hey, you're contracted to do 40 hours a week, but you'll only be paid for 38, and each week you'll bank 2 hours, and in that 4th week, you'll take an RDO. That's a roster date off scheme. That's a formal RDO scheme. So the way they work, bank some hours, and then when you've got it, you take that leave. And when you take that leave, it's paid at your ordinary rate of pay, and it's superable. Same concept with on termination. It's paid out at your ordinary rate of pay, and it's superable. Unlike unlike the time off in lieu, which when you pay it out is paid at the relevant overtime rates. Clearly, because it's paid at overtime rates, it's not ordinary time earnings. Overtime is never ordinary time earnings. So time off in lieu paid out on termination as an ETP will not be superable. All right, current legislation under review. I'm not sure if you're aware there is a bill under review. It hadn't passed, I think, as of a couple of days ago. I had a quick look, but not a proper one. It's a couple of things to look out for payroll personnel. The first one is it plans to remove that $450 minimum per month. You know what I'm talking about? Really? Yeah? Okay. So if you're not aware, an employee who earns less than $450 per month results in an employer not having an SG liability for that employee. They're planning on removing that. The second one, whilst it may not mean much to you now, if you're under a salary sacrifice arrangement where you instruct your employer to send some money to super for you, in the eyes of the ATO currently, that's deemed employer contributions, not employee, employer. Employer, okay? What does that mean? And if you don't believe me, straight from the ATO website, have a look at this. You've got Sally and Zoe. They both earn $60,000. Zoe says, hey, can I please salary sacrifice $10,000 to super? And the employer says, yep, no problem. So as you can see, the reduced ordinary time earnings is $50,000. And we all know now that the employer is liable for 9.5%, for Sally on the $60,000, and for Zoe on the $50,000. And you can see that calculation there, $5,700 and $4,750. In the eyes of the ATO, when the employer sends money to the super fund, they have to send $5,700 for Sally, and for Zoe, they only have to send $10,000. Their liability of $4,750 can be absorbed by Zoe's salary sacrifice. So really, the employer has no liability. If you're all aware of that, sorry to bring that to your attention, and certainly please don't go implementing it because you'll end up with no staff. So if the idea of this piece of legislation is to remove the words that these are employer contributions, therefore making that 9.5% for $4,750 payable for Zoe. Okay, they're the two main things, that $450 and this needs to be removed. Well, they're the things for payroll personnel in that bill at the moment that's currently under review. I'm not familiar with any employers that do this, that use the salary sacrifice contributions to meet their SG obligations. You may be, I'm not familiar with anyone who does it. It's not best practice, but that is the law and it's certainly legal to do so. All right, keep an eye out for that piece of legislation. So, this is the last one, obligations of the super fund. I don't know how many times I've received a phone call saying, hey, Maria, the super fund's just sent back a payment, but it looks like it's 7 months old. Do I have to complete the SG charge statement? Generally, the answer would be yes, because you've not met your superannuation obligations, you've not remitted the correct amount to the employee's nominated fund by the quarterly contribution date. So you would be liable for the SG charge statement. But if you go again to the ATO website, there's the link down there. But it's just as easy to go to the search field and type in the words QC space 47559. You can read it with me or you can read it on your own. But basically, if the employer sends money to the fund via the clearinghouse and the fund gets it and says, I don't know who this belongs to, the fund has 5 business days to turn around and ask the employer, hey, who does this belong to? The employer then has a reasonable time to respond. I think it's 10 days, yep. And if the employer doesn't respond, the fund again must follow it up within 10 business days. Then again, if the employer still doesn't respond, the fund has 20 days to send that money back to the employer. So if you have a look at this, basically the ATO is still giving a reasonable time frame for the employer to get the information to the fund so that they won't be liable for the SG surcharge or the SG charge statement. If you are getting money back from your fund, and I did it the other day with my own, ask the fund to go to the ATO website type in that QC and have them read it out to you, and then wait for the phone call 3 days later. It is their obligation. The funds are not even aware of this. So if you are getting back payments that are well and truly in excess of 30 days old, you need to take this up with the fund. They are not meeting their obligations, and it's going to result with the employer having an SG charge statement to complete. All right, some general payroll tips. Athena just stole mine, because basically use the PAX calculator on the Fair Work website and use the resources that the ATO and Fair Work have. They're actually quite good once you find them. All right, keep updated with legislation. So you can subscribe to the Fair Work website, and you can ask for you can get their subscriptions and their newsletters and everything like that. Same with the ATO. And if you had, just on that, I think it was yesterday, they've released, if you're not aware, make sure the stationery that you issue is also up to date. For those of you who are still giving TFN declaration forms as opposed to doing them, through your system. If you're issuing your TFN declaration forms, there's a new form that came out yesterday or the day before. Make sure you're issuing that. It's got nothing about do you want to claim zone offsets or seniors and parents. It's got nothing like that. The two changes that you'll see is that sort of information has gone. There's no requirement for the employee to complete that. And where it says, are you an Australian resident for tax purposes, you now have 3 options: yes, no, and holiday maker. So make sure you're using the correct forms. All right, do some training or get qualified, and you can become an APA member. That one does come with a caution. Thank you.